Hey, and welcome back, investors, to the New to Investing show. Today's episode, we're going to be talking about the 50-30-20 rule. With 2020 coming upon us and already being here, I should say, we are going to explore this pretty interesting and I think very useful rule, the 50-30-20 rule, to help kind of increase your savings for 2020. So overall, what are we going to be covering this episode? We're going to be discussing your needs in life, your wants in life, and essentially what are you saving in life. The 50-30-20 rule is pretty straightforward. 50% of your spending should be on your needs, the essentials in life, your rent, power, water, gas, your internet, phone bill, car payments, you name it, anything that's essential to you and your kind of overall well-being or existence, that's going to be considered 50% of your spending in the 50-30-20 rule. Now, 30% of your spending should be your wants, the non-essentials, whether that's dining out, buying new clothes, attending events, sporting events, whether you're purchasing things or materials for your hobbies, you're purchasing new technology, anything like that. That's going to be kind of all clumped or grouped into that 30% of your spending, or at least it should be. And then ideally, your goal should be 20% of your take-home after-tax income. 20% of that should go towards your savings. So it's whether it's going to be a stock account, a Roth IRA, or even a savings account. Pretty straightforward stuff. To kind of demonstrate this, because the 50-30-20 rule kind of makes sense on paper, to kind of demonstrate it, it puts it a little bit more into perspective. What I like to use is an Excel sheet to track my expenses for each category. That way I can see month over month how I'm spending, my spending limits, my kind of different themes that I can pull from each month. Keeps my spending under control. I highly recommend it. We'll review some of it right now. So in this Vic example, we're going to get a work paycheck for $3,200. Now that paycheck, as most people have, is pretty consistent throughout the month. Or throughout the months. So for the first 3 months, January, February, and March, you see that $3,200 every 30 or so days. Now for our first section, we'll be starting with the needs, the essentials in your life. You have rent, internet, gas, power, phone, and even maybe a car payment. We're going to break this down by $1,200 for rent, $60 for internet, $40 for your gas bill, $50 for your power bill, $100 for your phone bill, and $150 for your car payment. These are obviously kind of rough numbers, rough estimations. It's going to vary for every single person watching this video. But just for this example, to kind of highlight the 50-30-20 rule, your needs in life, or 50% of your spending, comes out to $1,600. And how about that? Conveniently, it's right at 50% used. So out of $3,200, all of my essentials in life, my needs, are $1,600. That gives me a remaining balance to spend of $1,600. And as you can see, for most bills that are consistent, in my case, my internet, gas, and power and phone bill stay consistent throughout the year. We're going to have the same amount of charges for February and March. So it's not too complicated. Collecting a list of all the bills that are repeating every single month laid out in a list in front of you is extremely helpful and helps kind of tell your story of your spending habits on your needs or essentials in life. I highly recommend a lot of folks do this. So now you ask, what are going to be the wants? So some of the categories that I personally use are going to be through clothing, entertainment, food, or dining out in this instance, travel, or even rideshare. So if you take the train, take the bus, Ubers, Lyfts, bicycles, or even scooters nowadays, that would be tracked underneath that. And then lastly, you have the last two are going to be any hobbies that you have, whether that's reading, painting, maybe working out, or some sort of other activity that you have to pay for. It would be tracked there. And of course, all other expenses. The one example I like to use is maybe parking tickets or any sort of other expense that doesn't fit in these other categories. I keep it at these amount of categories. You can break it down further just because there's hundreds of categories. I like to keep at the basics. I usually group a lot of things underneath entertainment. Usually entertainment, food, or traveling is kind of the three big spending categories for most people. But for this example, let's go ahead and break down the 30% for your wants, the non-essentials. So obviously for these 3 months, those six categories are always going to vary. But for January, the month that we'll review, we'll start with $120 for clothing, $240 for entertainment, $400 for food or dining out for the month of January, $100 for ride shares, whether that's scooters, Ubers, Lyfts, trains, buses, $20 for our hobbies. Maybe one of your hobbies is reading. Maybe you purchase a $20 book for the month of January. And then, of course, 80% for the other category. Maybe you got a parking ticket for $80. Hopefully you did it. But in case you did, you could track it there. I don't think you would put it underneath it. Entertainment. So what's your grand total? Well, in this fake example, again, those are fake numbers. That's going to total $960. And again, conveniently enough, that's going to be 30% of your take-home paycheck after taxes. So 30% of $3,200 is $960. And again, if we go back to needs, remember remaining we had $1,600. If we minus $960, we're left with $640. And obviously, since our main goal through all of this is to always have 20% for savings, we have $640 remaining for each month, January, February, and March. Lastly, out of the 50-30-20 rule, 20% of your take-home paycheck after taxes should always, always, always go towards your savings. Whether you need to cut costs on some of your bills, if you need to downgrade your internet, or any sort of example like that, downgrade your phone plan, or even cut down on some of your non-essentials. If you eat out at lunch every day after work or anything like that, cutting down on Ubers and Lyfts, take the train, take the bus. Cut down on those first before you ever do savings. Savings, you always want to try to keep at 20%. I cannot stress enough how much this will help you later in life. But for this example, we had $640 remaining for each month. So for the month of January and for every month after that, I have enough money to put $500 in my stock portfolio. That's a good amount of money. And then even I had $140 left I'm putting in a savings account. And in this instance, maybe I'm using a savings account because I'm making a large purchase soon. Maybe that's a new car, down payment on a home. Savings account, I'm just kind of putting it there. Just it's readily available. The liquidity is there. I can easily take it out, but also earn money on it or interest at the same time. So $500 for my stock portfolio, $140 for my savings account. Obviously, I'm using the remaining amount of money that I had for the 50-30-20 rule. That gives us a grand total of $640. And I obviously used the perfect 20%. And then, of course, there's $0 remaining. As you can see in this quick example, I've budgeted all my spending. I've broken it down to each category. I'm tracking my expenses. And I have a perfect split of 50% of my needs in my life, the essential items, usually bills that are reoccurring. 30% on the non-essentials or the wants in life, whether it's dining out, entertainment, hobbies, traveling. And then, of course, the most important one in this whole entire example is going to be that 20%, whereas 20% of your take-home paycheck should go towards your savings. That's going to be the main category to stress. It's okay if you go over in the other categories, but as long as you're hitting that 20% or making cuts or adjustments elsewhere to keep that 20%, or if you're near it, then you're going to be just doing great at the end of the year. So, quick recap for the 50-30-20 rule. The 50% are going to be your needs. These are the essentials in your life or on a monthly recurring basis. That's mainly going to be your bills that we covered. The wants, obviously, they're going to be focused around your entertainment, dining out, anything in life that you could technically go without. But obviously, since life would be pretty boring without the wants in life, it's always okay to splurge every now and then. It's important to enjoy the small things in life. You just have to make sure that this is the key area, the wants, that you have to focus on your spending. I think a lot of folks, if they do this for the first time for the last, 1 or 2 months, they've probably spent the most money in wants, when in reality it probably should be in the needs. And then lastly, savings. Again, I personally start with savings and put 20% there, then work my way down through my needs and wants. But a lot of folks are gonna deal with that section last, which is unfortunate. But the last 20%, or I should say the first 20% of your take-home paycheck should really go into your savings. Whether you have a savings account, a Roth IRA, 401k, anything of that nature, you should put 20% in there first. Hey investors, Jason here. I just wanted to point out and highlight one quick thing. when I'm referring to the 20% rule for savings, it's obviously going to vary the type of savings that each individual user or person is saving in. Not everyone is in the same point in life as everyone else, whether you're coming right out of college, you're saving up for your first house, your first car, you're about to start a family, you're about to switch jobs, so you want more financial security. Where you're storing that 20% is going to vary. The ones I'm saying here are just examples. There's entire books, there's entire sections. I'm going to create multiple videos on each individual savings kind of vehicle, whether that's a stock portfolio, a savings account, Roth IRA, 401k, yada, yada, yada. We will cover those. These are just examples. I'm not kind of pushing people towards one or the other. I personally have majority of them. I have a stock portfolio. I have a 401k with my employer. I have a Roth IRA, a checking account. There are various forms. For a beginner, for someone who's new to investing or saving their money, you're probably going to be putting your money in a checking and or savings account. So just wanted to quickly highlight that, and we'll get right back to the show. Thanks. All right, so that's the 50-30-20 rule. We're going to go to some viewer questions. Again, these are going to be some repeats from our last episode, but I think since this channel is pretty new, I wanted to reiterate and echo these questions that we had. So the first question is, how often are episodes released? And I personally plan on releasing a video and a podcast on a weekly basis. I hope to do it on a daily or every other day. That would be really great. I think it would help grow the channel since it's brand new. Second question we have is, what are the types of content that will be covered on this channel? And that's pretty straightforward. Hopefully the title of the channel gives it away, but it's the New to Investing show, so a lot of the topics that we're going to be covering are just going to be the basics of investing and money management. A lot of the items that we cover, you should expect them to be very beginner level, very introductory, and just materials that are very simple to understand, and we're going to grow from there. So as the channel matures and as things progress, we'll get a little bit more complex, and we're just slowly going to build a strong foundation of knowledge for money management and investing, and then go from there. And then lastly, a really solid question is, where is this information coming from? I think a lot of YouTubers provide great content. In some instances, they provide great entertainment. And that's where I'm always hesitant to subscribe to a channel or to leave a comment or a like, because although the video was entertaining, was it accurate? Did I learn something of truth from it? Or were they just stretching the truth or telling a white lie to get a new subscriber or a new follower? I personally try to pull my information from trusted sources, from professionals, from experts in the field through their YouTube videos that I usually link if I reference it, from well-published books that are bestsellers, or any published articles. I try to reference those and pull my content from that. Just well-sourced, well-respected articles and books that are always highly recommended, and again, professional videos that professionals in finance are in. That's usually where I try to pull from. And of course, as the last section there says on the screen, when I do cover those topics and I do have those references, I will always provide credit to those people and to those folks. I usually try to leave a link in the bottom of the comments if you want to learn more about it. All right, and if you're new to the show, we always try to have we always try to have a term of the episode. And for this episode, we have discretionary spending. Hits close to home. Very similar to what we just discussed, almost the exact thing. Discretionary spending is going to be money spent by people on non-essential purchases such as vacations, luxury items, and entertainment. So now you know. For those folks who have their needs category in the 50-30-20 rule at 30%, your discretionary spending is probably way too high. That is the first section that you should go after. Maybe cut down on the amount of times you go eating out for lunch at work. That I noticed with friends and family and coworkers, that is one section that could be easily addressed almost right away. Instead of eating out every single day of the week, maybe just start with 2 days of the week, maybe Mondays and Fridays. Those always tend to be either the most dreadful ones, being Mondays, and the most exciting ones is Fridays. It's okay to celebrate with your coworkers. Eating out at lunch during work is a great way to communicate with them and build new relationships. So I'm not saying cut it out entirely, but maybe just cut it down instead of 5, maybe down to 2 or 3. You'll see yourself saving hundreds of dollars in most instances. All right, and before we wrap up the show, I'll just do a quick little social media outlet plug. If you're on Twitter, you can find me at New to Investing Show. If you're on Instagram, New to Investing Show with periods in between each word. Facebook at New to Investing Show. Same thing with YouTube at New to Investing Show. And then if you just Google at New to Investing Show, you'll find all the social media outlets, including all the podcasts. I try to do all the major podcast outlets as well. And then we have a website coming up soon. It's under construction, but we will have it up there with some additional information. All right, so lastly, if you've learned anything new in this video, please feel free to leave a like, a follow, subscription, or a comment. Obviously, I greatly appreciate it, and it really helps grow the show and the channel, more importantly. So thanks if you do. And credits for this episode, the presentation that I've used was a template used by SlidesGo, icons by Flaticon, the infographs and images symbols were created by FreePick. Blackmagic Design DaVinci Resolve Video Editor is a free-to-use software that I use to edit my videos. I don't know what I would do without them. And then, of course, Investopedia, the 50-30-20 rule. I got a lot of the information from Investopedia. It's one of my main sources. I've known about this rule for a while. I've applied it for the last year. It's paid me dividends time over time, and really no pun intended there, but it's extremely helpful. In the next episode, we'll be discussing building out your own cash flow, the examples that we used earlier. And then lastly, the term of the episode was brought to us by businessdictionary.com, another solid source. And for the disclaimer for the episode, the New to Investing Show is for informational purposes only and is not intended to serve as a recommendation to buy or sell any security and is not an offer or sale of a security. The New to Investing Show is also not a research report and is not intended to serve as the basis of any investment decision. If the New to Investing Show covers a service or a security that one of the hosts uses or owns, we'll make sure to let you know. And that's going to do it for this episode. Remember, the 50-30-20 rule, such a great rule to live by, to spend by. If you track your spendings, I think it's the first step to leading a very fulfilling and successful financial life. And I think a great way to kick off the new year in 2020 and to really focus again on that 20% of savings of your paycheck. All right, I think that's going to do it. Thanks everyone for watching. Thanks everyone for joining. If you leave a comment, if you subscribe, I highly appreciate it. And we'll catch you guys in the next episode. Thanks so much. See ya.